Hello, welcome back to theCUBE here at the NYSE Wired CUBE special coverage of HF0 House in San Francisco. This is the place where founders gather and spend a small amount of time, a couple of weeks, and do about 2 years worth of work building companies. It's a new way to build entrepreneurial ventures. Of course, focus on founders who lock in and solve real big problems. Prabhu Palani is here, CIO, Chief Investment Officer, San Jose Retirement System. He's one of the guests here enjoying the evening festivities where the founders and investors meet and talk, and they get to know each other and they share opportunities, and magic might come out of it, like money and checks, but who knows, but that's not really what it's built for. Thanks for coming on theCUBE. Appreciate you coming on.
Thanks, John. It's an honor.
You know, it's really an interesting time. I want to get your thoughts. I want to get into some of the investment things you're working on, but the HF0 to me represents like a unique time in history where you have entrepreneurship with real opportunity to make change, and they're locked in. It's almost like sports. It's like camp. You lock in 8 weeks, build with a team, bring in resources for you. It's like the NFL. It's almost like watching, like, you know, pre-training camp. This is very intense. This is not like another incubator, and they come out with a company. And so it's really primed for investors. So first of all, what do you think about the HF0 model? What's your thoughts on that? And is it a moment in time, or is it sustainable? What's your view on how they're doing it here? Because it's a new form of entrepreneurship.
Yeah, no, totally. Look, it's amazing, right? You know, what they're trying to achieve here. And let me step back and, you know, sort of elaborate on that, right? So I'm going to give you a little bit of history and background on the public pension system itself and where HF0 actually fits into this. And let me know if it's too much detail at any point in time. Look, I manage a California pension plan, right? And we manage about 10 billion in assets. And most California public pension plans are about 70% funded, right? We are no different from the two big ones there, CalPERS and CalSTRS. You know, we've had a good year, so maybe we're, you know, up to 75%, but we're all underfunded. And that's very similar to pension funds all over the country. Right? So you have to find every bit of excess return that you can get, right? Whether it's public equity, whether it's private equity, venture capital, you have to be innovative. You cannot leave any stone unturned, and that's where HF0 comes, right? When we thought about our venture program, I've been at San Jose 8 years, and we've had the venture program for 8 years, right? And so when I came on board, I told my board as a precondition for my joining San Jose is to start a venture program. Right? If you fly into San Jose, you'll see in the airport, it says capital of Silicon Valley, right? We are in the middle of this tremendous, you know, venture activity and ecosystem, all these great companies being formed all around me. And why are we not taking advantage of it, right? So our ecosystem, our policemen and firefighters are keeping this place safe, but we were not benefiting from venture. So first decision was to get into venture. Right? The second question is, how best do you then make utilize of this, you know, how do you utilize the space? And clearly, you know that access, it's an access game, right? It's not easy to get access to some of the best known names. And some of the best known names are going to be different going forward. So we made a conscious decision. We did a lot of research, and we said the value add is really in early stage. Right? Is in founders and in seed stage, and that's where HF0 is part of that puzzle to help us, right? So I think what they're doing is amazing. It fits into our overall puzzle, and, you know, up until the tech wreck of 2022, valuations were very frothy across all tech, the entire tech landscape, including startups. So again, we made a conscious decision to be at the seed stage.
Yeah. And that, if you look at the returns, I mean, it takes the one home run, as they say, to kind of yield the fund. I mean, Figma just went public, and that, you know, obviously Greylock and Index and Kleiner Perkins did well on that. So you get in early, you can hang in there and just kind of ride it.
That's right.
So that's a game of access, like you mentioned, but also it's a game of getting the hits.
Yes.
And if you don't step up to the plate, you can't swing.
That's right. That's right.
Then you got to play on either the dilutive rounds, people the positions are smaller. How hard has that been? Can you just scope the magnitude of what had to happen? Because it's not obvious, because people would think, oh, the venture guys, they dominate, the Sequoias of the world, they still get access. But that's changing. Talk about the market and the scope of how hard that was to change or not. Was it easy?
Yeah. So it's as I told you before, it's an access game. And unlike other asset classes, there's a lot of return dispersion here, right? So if you have an average public equity manager, if you have an average fixed income manager, you're still going to do well because the standard deviation around the mean is very, very tight, right? That's not the case in venture, right? So if you look at, you look at projections, it has been the best performing asset class of the last 3 decades. It's still projected to be the best performing asset class going forward, but it's all coming from the top 10%. If you look at the median venture manager, you're actually going to be after fees, you're going to have negative returns. So you really want to aim for that top 10%. That's not easy, right? You go to a firm like Benchmark, right? They have a backlog of years, right? They have a long line of people waiting to get into that firm, right? So it's not just identifying those firms, it's then how do you get that, right? And also another point to make is the guard is changing, right? The future winners are not going to look like the winners of the past 3 decades. And that's where a firm like HF0 comes in.
Yeah, and I like HF0, and also I want to get your thoughts on another trend that impacts you, because again, you're in Silicon Valley, you're the heart of it. It's all around you. Silicon Valley, it's, all the chips right around. All those police and firefighters are out there protecting the chips for us too. Is the trend that I want to ask you on is a lot of entrepreneurs in the early stage are going to other founders. And I've heard from a lot of LPs that tell me, hey, we're backing the solo GP, the solo general partner, because the capital requirements of the seed have changed from the traditional, blue chip firm to the multi-time founder who's made some wealth and it's trusted. And now you're starting to see money back. What on paper, that doesn't really look good on paper relative to a profile of what a venture class is, but they're not just scouts, they're actually implementing, deploying their capital, personal capital, their own little family office, if you will. What's your thoughts on this? Because this has been a big dynamic over the past 5 or 6 years.
Exactly. I think especially after COVID, you see a lot of this, right? And so I think there's real value here. But in your due diligence, what you really need to know is their motivation, right? Is it just somebody who's had a very successful exit and who basically wants to sit on the beach and who's going to be an angel investor and throw around a little bit of capital? Or are these hardworking people, right? And in fact, I was just talking to someone just before this interview, and you can actually have, there's 2 classes of, those very successful people. Some have made it big and who want to take it easy. And the others are the ones who continue to think like a VC, right? It's not enough. They're not going to rest on their laurels. They have their big exits, but they want to continue to, back other companies that are going to be unicorns.
And they're mission driven too, because they've been there and they're leaning into your point about sitting on the beach, clipping coupons and, sailing their yachts around. They're actually into it.
That's right.
That's what you're saying. You're looking for that profile.
That's exactly right. Yep.
Yeah, and so that's good because now they have trust. So what about the trust factor? Because that's become a big thing too. You're starting to see founders saying, I want to have help when I need it, but let me go do get that beachhead. I need to secure product market fit. I don't need board meetings. That's kind of evolved. That's not around anymore. Now it's more, get a little bit of leash, run a little bit. Andy Grove used to say, let chaos reign and then reign in the chaos. That's what founders do. What's your thoughts on that kind of that dynamic?
Look, it's always a balance, right? I'm a fiduciary for a very sacred pool of capital, in my opinion, right? Because I'm looking after pensions, pensions for retirees, right? So there's got to be a balance always, right? You want to give them the freedom, you want them to explore, you want them to go and do the next best thing. They're also responsible. Right, they have to be, and they have to be accountable to someone.
You mentioned some of the numbers earlier on some of the means and some of the in the venture class. Obviously, you have sacred pool cash. It's not like you're freewheeling just venture. You got a lot of other things. You mentioned fixed income. What's your risk profile on how you balance that? Because venture is not for the faint of heart either. There's risk involved.
That's right.
How do you look at the risk equation? Is there an algorithm? Is there a formula?
I mean, it's very much like an algorithm, right? So we have an asset allocation model, and we look at risk in totality, not just at the venture space. So there's various kinds of risks that I'm looking at. I'm looking at drawdown risk, because if I have a big negative year, then the city of San Jose is on the hook, right? to actually make up the shortfall in pension. This happened to us in the great financial crisis, and in 2008, 2009, and when that happens, they had to lay off policemen and firefighters. So it's a delicate balance that you're playing. On the one hand, you don't want steep drawdowns. At the same time, we are underfunded, so we have to take risk. So our profile, just to give you a direct answer on that, is right now it's about 70 to 75% in what I call growth assets, and venture is part of that. And then I have another 15% or so in what we call low beta assets that are uncorrelated to the market, and then another 10% that's an inflation hedge mostly. And within the growth bucket, I have a dedicated 5% allocation to venture.
That's where you're squeezing the returns out of the growth bucket.
Absolutely.
The rest is just kind of like foundational, steady state.
That's
balances any kind of cyclical, any kind of macro action going on in the market.
Exactly. And I also have to think about liquidity risk, right? Because we're actually paying about $500 million every year in pensions, right? So I need to have the cash to pay that out, right? So I'm also balancing liquidity risk here. But look, I think the advantage of being a pension plan is like being a college endowment or being a religious institution, right? These have all been around for hundreds of years. So the city of San Jose is going to be around 100 years from now. The pension plan is going to be around 100 years from now. That means we are patient capital, right? We are long-term capital.
You have to play the long game.
You
get
have
a lot of responsibility, and you got the sacred capital.
And it's a luxury too, because I can really look out, right? And I'm not managing for the next year, 12 months or 24 months or 36 months.
You got good discipline. I want to ask you about, we'll get into the event tonight, but I want to ask you about research. The OpenAI research is going to be here. They're going to be talking about AI. We're in the heart of Silicon Valley. There's a lot of research institutions here. Big, small, medium, a lot of action, a lot of brains, a lot of action. What's your view on the Cals, the Stanfords, the community colleges, the schools, San Jose State? There's all these colleges with really smart people. Do you factor that into your due diligence, some of the research action? How do you look at that? How do you frame that into your equation?
Yeah, 100%, right? So when we started building out this venture program, one of the things that I was keen on is partnerships, right? And one set of partnerships is with academia. And like you said, a lot of this talent is coming from this ecosystem, right? So we are right next to San Jose State, a very underrated school with a top-notch computer science program. Everyone knows Stanford, everyone knows Cal, and then people don't know UC Santa Cruz is not that far from us. So we are actually in this ecosystem. You know, prior to AI becoming so big, there was talk that the center of gravity is shifting away from Silicon Valley. And, you know, with AI, it's just, once again,
it's just all syndicated.
It's absolutely, right?
You mentioned San Jose State. I want to ask your thoughts on demographics, because one of the things that's happening that I'm super psyched about is that the democratization wave is actually happening. Podcasts are hot. You're seeing access to capital, access to technology. If you're a domain expert, the ability to use AI and even blockchain infrastructure, which is changing financial institutions. We've just been covered that all last week in New York. That's changing. Everything's up in the air. It's going to come down. So it's not just Stanford, Cal, and the big schools.
That's right.
It's everyone's got computer science now. In fact, computer science is now a bot. So people have auto coding and coding assistants. So now we even more superpower for the intellect.
Low barrier to entry, right? That's what it is, right? Anyone can start a company now because they have all these, tools in their toolkit now.
Are you seeing a lot of action in entrepreneurship relative to tech that's a little bit different? Has it changed? I mean, I sense it's changed a lot. I just can't put a percentage on it. It feels like a sea change. How would you say that the tech entrepreneurship, not technology, but like all industries are going to be impacted by tech. So it's more of like, what kind of level of entrepreneurship is delivering tech that you see? Can you like give a percentage of what change has been? It used to be nerdy, tech nerds do their thing, they get their venture going, but no, not anymore.
No, I think you're right. I mean, I think you had to be, a few years ago, right? You had to be that, you needed the deep technical expertise to go and start a company, right? Now, like you said, a lot of the coding is a bot now, right? So if you had a great idea, I don't know what the percentage is, but you have entrepreneurs not coming just from the computer science department, from the business school as well.
Yeah. I was talking on our podcast about a debate we were having around how AI is displacing jobs, and I have my stance on it that the ATM was supposed to kill bank tellers. Now there's more bank tellers.
Yeah.
And the conversation was programming is going to be accessible for more people. But the alpha developers, if you looked at the actual data that we did research on, they were going lower in the stack. So they work at NVIDIA. So they're working on chips.
Yeah.
So chips are back. And I want to get your reaction to that, because the entrepreneurship tech level of proficiency isn't really changing either. The hardcore engineering is still happening.
Oh, absolutely.
It's just going down closer to the hardware.
That's right.
Because that's where it's hardest.
Yep. Yeah, I mean, for a while there, you could see that software was sexier than hardware. Not anymore after what's happened to NVIDIA.
Exactly. Yeah. All right. So what's your goals here tonight? Great event. It's going to be very chill, relaxed, get some presentations. What's your objectives here?
It's all about learning, right?
Yeah.
And like you mentioned before, it's a fast-changing landscape, right?
Yeah.
Want to meet wonderful founders and want to learn about the fast-changing landscape. That's what it is.
Well, thanks for coming on. Appreciate it, and we'll see you out there.
Of course, great.
Thanks.
Thank you.
All right. I'm John Furrier at theCUBE, here at the HF Zero House. Again, a new equation in entrepreneurship, which is booming in all aspects of our life as tech is infused. And entrepreneurship equations really rising up across all sectors. More coverage coming after this break.